Alrighty, let's go ahead and get started. Welcome everyone to the HUBB Live Trading Room. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do need to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, the market has taken a much needed pause from the rally earlier in the week. So where do we go from here? I'll leave that to Rob to answer. Rob, you out there?
Hey, I'm Zach. Happy Wednesday afternoon, everybody. Go ahead and grab the screen here. And as you mentioned, we did need a little bit of a break, especially after the rally to start the week. Clearly, the market enjoyed the news that came out around 3 a.m. On Monday morning about a lot of people talking about the deal with China. Is really a pause, the 90-day pause in the tariffs, bringing them down to adding in the fentanyl tariffs, et cetera, to 30% from the 145%. But they were very constructive comments from the president and the administration that they feel like an amicable deal is going to be worked out. So right now it's 30% on our side, 10% on their side from the tariffs. So that's given a little bit of a break to the markets. And we gapped up yesterday. And as you know, I don't like gaps. So we get this big gap to the upside here. And on top of that, we got a little bit vertical away from the 10-day moving average. And by now, you're aware of the rules. When you get too far from the 10-day moving average, you're either going to pause and let the 10-day moving average catch up. You're going to back up a little bit and meet the 10-day moving average. But at some point, the actual security, the chart, and the 10-day moving average are going to come back together. So right now it looks like a little bit of a pause. We did have a nice follow through day yesterday. So we have broken significantly resistance at 575. I've drawn a zigzag here in this wave 4 correction, although the 91% means that that LA wave pattern is disqualified. So that pattern will go away, and then we'll wait to see what the software does to relabel the new pattern once it becomes clear. Likely this could be an impulsive move to the upside, especially with this zigzag here. We moved past 100% with a 50%, 55% B wave correction. So the 100% was the target, but we just gapped right through that. So do we run straight up towards this 600 to 610 level? And that's where I think we wind up at the previous highs. It's just what happens in the meantime. Do we back and fill a little bit, or do we go sideways as we're doing today, and then turn and move back to the upside? For me, you likely need to keep a bullish stance. We've been very cautious, but with that break above resistance, as long as we can hold 575, then we need to stay long. At some point in time, percentages say that gap will get filled, but as we know with gaps, it can take some time before that occurs. So we'll just have to wait and see what the market has in store and how that plays out. But for now, all signs are good except for, and I'm going to switch over to TLT, the bond market. Move over to the bond market, and it's not cooperating. And I've discussed this in the last several webinars. Why are prices on the 20-year going down, and therefore yields and rates going up? As you know, they move inversely. So as prices come down, yields and rates are going up. We're a little bit oversold here on bonds, and there's an argument to be made that the bond market is not confident that we're going to avoid a recession, and that the economy is going to continue to weak, and the Fed will be late to the party as far as cutting rates. We're out to September now without reiterating what I've talked about earlier in the week on when the Fed's going to cut. But we are nearing this level of 100% on the zigzag pattern to the downside here for the TLT. I'd hate to see us go all the way down that far, since we only had a, call it a 38.2% B wave correction. 61.8 was what was expected, kind of where we closed yesterday. So hoping that maybe we'd see a little bounce up in prices and move down in yields. Hasn't materialized so far, but I do think we're going to at least have a short-term bounce in the prices, and that could put a renewed bid under the equities market. But as long as bonds are acting this way, and the bullish argument is it's simply money ran to hide in the bond market when we had all the tariff stuff going on and we had the big downward move in the markets, and now that money's just coming back out of the bond market and getting ready to be allocated into the equities market. We did see, I believe it was yesterday, all Mag 7 stocks were to the upside, all of them. There's definitely an appetite for risk. You've seen the charts by now over the previous couple of days of what's going on in the crypto space. Nice rally there. They need a pause, and they're getting that as well. A little bit of sideways movement here on the BITB, which is the Bitwise Bitcoin ETF. Resistance levels from December and January. We're right there now. We're a little separated from the 10-day moving average. The fact that we're just consolidating sideways, at least at this point in time, needs to be looked at from a bullish standpoint, with the possibility that we allow the 10-day moving average to catch up and then we break up and take off. If we look at the TNX, so we go a little bit shorter on the yield curve, there you can see where rates are moving up there. And we had this triangle, although it wasn't a very well formed one. So you got to take that with a grain of salt. Pretty good series of lower highs here, but not so good on the higher lows. We get this big, huge break here. So it's not the most well formed triangle. Perhaps it's not going to come to fruition the way it normally does. But rates going up. On the short end, rates going up. On the longer end, the yield curve is flat. It's no longer inverted, but it's pretty flat, meaning that you're not getting that much more for holding bonds and treasuries longer than if you just moved in and out of shorter maturities. So when you hear a steepening yield curve, that's when things are the way they're supposed to be, where, pardon me, the longer you hold the bonds and treasuries, the more interest you earn. That's how it should work. So we do have to keep an eye on why the bond market is acting this way. And over the next couple of days, maybe we'll know a little bit more tomorrow night in insiders, maybe not that fast. But over the next several trading days, it will become more clear as to why the bond market is simply not wanting to play nice or cooperate. I did want to show you the VIX because we talked about that during Trade Finder yesterday, whether or not we were going to hold here at 17 and a half or break below it and work down to 15 or even 12 and a half. Well, for now, the 17 and a half level is holding. We're at 18 and a half exactly at this moment. Do we come back up and fill this gap? Do we go back up and test 22 and a half as resistance now, where it consolidated above that level of support for a while and then broke below it? Really kind of non-committal on the VIX, other than we're back down in a range that could yield some support for the equities market moving higher from here. We'll just have to wait and see how that plays out. But this is the HUBB Live show. So we're talking about AI. So let's go over to the AI searches. And as I do each and every week here, I don't do anything on the AI before I get a chance to talk to you, so we can talk through things before we send out any sort of alerts. And when we take a look at NTR, which you can see has an 82% score here, we look at this. We had a big day yesterday, so we didn't want to chase that. And then this pullback today makes it quite interesting, especially if we can hold here, because a little bit, not a lot, but a little bit of support right here, because we consolidated at the end of April and early May at this level. So we'll do some options analysis right after this and see if this warrants sending out an alert. Certainly like the scores above 80%. And we've got a nice amount of room to run here, which is really interesting on NTR and attractive. So when I see something that sets up that well, there's a couple things that I want to look at. First, is there a zigzag pattern here? And in the wave three, that's my favorite, having a zigzag within the wave three. We look here and we've got a corrective move that just barely got to 30%. And that's the only level where Elliott would begin to become interested in a corrective move. He let it label at 23.6 because it's a fib level. But again, the difference between rules and guidelines, and the guidelines are rather see a 30% plus corrective move before you get excited about the potential for either a zigzag or an impulse pattern to play out. And looking here, you can see this level just above 61.8%, which is where the AI target is. And if we were to even give that the benefit of the doubt, it would be a 38% B wave correction, which would yield a move up to here around, it's called 61 and 3/4. I can give you the exact price here. If we take a look at it right there around 61, just leave it at 61, would be the first target, and that zigzag target would be before we get to the AI target. So now I want to see what the DMI has to say about this. And I would prefer to see the ADX come down a little bit further before it turns and goes back up, but it's going to do what it's going to do. We had this first run in the A wave impulse of the zigzag. So this move here had a very classic setup with the DMI, where the ADX was moving up between the two directional indicators, etc. Pretty classic movement, although once again, we didn't come back down quite enough as I would have liked before we switched over from this downward move here that occurred at the end of March and early April before turning back up. But you could also make an argument here when you're looking at the ADX that we have a series of higher lows. So we're getting kind of a trend line, if you will, on the ADX. Not something that I look at too closely or pay much attention to, but any little thing that adds to the supportive nature of the DMI is something we want to pay attention to. And due to the fact that we know the DMI is a touch more of a lagging indicator, I want to bring the CCI in here as well. The issue here is that we have broken back below positive 100. So in looking at the CCI, we had the move up here, and then we spent some time above positive 100, which is what the shading means. Remember, on the CCI, the normal range is between positive 100 and negative 100. And then if we move above positive 100, which means we're getting into overbought conditions, it shades it. And if we get below negative 100, where we're maybe oversold, it gives a shade. And then we look for these extreme point lows. We didn't quite get one here from the high back in January on the CCI. So little bit of divergence there because we did make a new high here in the beginning of May, but we did not confirm that with a new high in the CCI. So all those things have to be weighed out. You're never going to get 100% agreement on everything across the board, I don't think. But once again, we put as many percentages in our favor as we can, similar to what the AI does with all their data points. They analyze them all. They don't all necessarily agree, but they take the average of them all. If you've seen the dot plot, I call it, of those images, look kind of like ultrasounds, and they find out what's the percentage of them all agreeing and the likelihood of going up and hitting a target. All those things get weighed out to give us the score on the AI and the target and fail zone. So the fact that we broke back below positive 100, again, I wish we wouldn't have done that. It was okay when we were here at the end of April and broke back below it on this movement down in the B wave correction. And then turning and moving back above positive 100 yesterday, all that was great. And just on the pause today, to see us dip back below positive 100 is a little concerning, but we wouldn't get real concerned. In other words, it wouldn't be a no-go signal unless we broke this low here from the B wave corrective low that did stay above the zero line. So we could just tick down and turn around and tick right back up. Remember, the CCI is far more responsive to day-to-day movements in the markets, which is why I like it as a mirroring Emmy, if you mirroring indicator. Gosh, I'm having trouble talking this morning with the DMI being a bit more lagging. So pretty interesting chart here. And once I do the options analysis, talking about the VIX, you know, we've done a couple spreads. We had a really nice spread on GEV. That wasn't a impulse AI event. That was just kind of old school Rob's rules there. So as much as we are relying on the AI, nice to know that we still have a little bit of positivity and the human element here with trading. But we also had a couple of nice closes on the AI impulse for shorter term trades. Uber, that was a pretty good exit, it looks like. If we take a look at the chart of Uber, pulling back a little bit today. So we took that 2-day movement, plus the fact that we hit the AI target. So you don't want to stay any longer than that. That one was a spread due to the fact that the VIX was a bit higher. And then we had the overbought condition, and you can see we moved back down. That's why we have all those rules. We had gotten 2 nice days. The negative on a spread is when you get a real vertical move like that. The short option, it's a call option, so it gets extra IV as well. So the extra IV in the long option is getting offset by the extra IV in the short option. So you don't get a benefit on a spread of a big vertical move, but we'll take the gain anyway. So we're not going to complain about having a gain. And then the EWZ, we hadn't quite hit our target yet, but once again, the 2 big up days. This one was just a straight call, so we did want to go ahead and take that volatility from the gap up. We did get awfully close to the AI target. We just didn't quite hit it, but that worked out well. This is an example of what I talk about during the insiders meeting a lot. When you see the results come out, and even though it was an 84 score, sometimes they just continue up in these momentum runs, because what we've learned is that the AI identifies these as momentum runs in the wave 3, and we pulled back on this one. So we had a bit of a drawdown before we turned and ran back up. So there's no rhyme or reason. There's no way to know for sure if the vertical move is going to continue or if we're going to pull back. We like it when they go quick, and we have those short 1 to 3 day trades. But other times, because of the fact that it's in a momentum run, it may need to come back here and do a little correction before moving back up. We had gotten here to where it looked a little dangerous of breaking below this support that was resistance back in February, again in March, and in early April. Breaking that was a little disconcerting, but we only had 1 day below the 10-day moving average. Even with that, there was a possibility that we were coming down to the 50-day, but we didn't. We reversed back up on the gap up and then headed higher. So those were nice. Next on the list is TITN. So this is going to be Titan Machinery, and the score is just not quite high enough at 65. Once again, a little bit overbought, but you're going to see that on all the charts because of the movement at the beginning of the week to start the week. But without that level, it's nice to see scores coming back again in our range of 75 or above. As you know, we get interested at 70 or above, but it actually gives the green signal. This little part on the right-hand side of the AI box turns green, as you know, if it's above 75. And then on the downside, there's nothing low enough to look at a fade. But let's go see what the bearish chart looks like. Well, it doesn't look like anything because there's nothing there. And then let's see if there's anything on the wave 5 bullish side. I've been asking the data scientists what the fade trade would be. The fade trade being a low number on the bullish or bearish side, where you actually go the other way on a real low score. And they said the data is inconclusive so far, they're not comfortable enough about putting any sort of a recommendation out on how to fade those. So I've been doing that on my own with some paper trading in a practice account to see what's the best trade to do when we have a low score on the wave 5. Is it best just to do something sideways, like a calendar spread in the trading range, similar to the time strategy setup? Or does it mean that we're going to continue down in the wave 5? And what I've seen so far, and of course, market conditions matter, and we've been on a bit of a rally, so I don't think there's enough data yet since the wave 5 searches were released to definitively say what we would do on the fade side on a low score with the wave 5 results. This one's 29, so it's not low enough anyway. You got to be below 25. But are we going to be in channeling patterns for sideways stuff, or does it mean the move is going to continue lower? Well, not too many things have continued lower with the fact that we've had the market rallying so hard. So that's what I said. We've had a strong rally pretty much since the wave 5 bullish search came out. So on the fading side of things, not really comfortable yet to even talk about what the ideal scenario will be, but obviously I'll be sharing that data with you after we have a little bit more calmness in the markets. Even if we just do a little back end filling, we don't necessarily have to come to the downside yet, but it's difficult to make calls when we're having a big upward run. And then we go over and look at the sideways and see what that looks like. Sideways after the drop, nothing high enough to look at. But you can see we've got a couple here that I think are interesting on the low end, potential fading. So United Health, gosh, the way this stock has moved, all the craziness that's gone on, all the news headlines going back to the assassination in New York, etc., that death, everything else that's been happening, some questionable accounting stuff, all kinds of things in the news creating havoc with United Health. It seems like that one would be interesting to do something for a breakout. But the problem is it's a $300 stock. So putting a strangle on is too expensive. But we'll continue to watch and see if there's some way to do something for a potential breakout move, even if it's just keep an eye on it and wait for which direction it's going to break. As a reminder, for those of you that are new, when we have a low score on the expected sideways move, the low score means it's likely not to stay sideways. It's not likely to stay in a one standard deviation range to the upside or downside following the drop. It's likely to break one of the two boundaries, and that's where the strangle scenario comes in. But we'll have to wait and see which way it moves here, because unfortunately, unless the prices of the options come way down, and with all the news that's in there and the anxiety around the stock, difficult to imagine the options are going to get cheap enough to where we'd be really intrigued by putting a strangle on. And then we have QVC, GP, Curate Group. I don't even know what this is. It makes you think like it's a TV thing, right? QVC. But this one's down around $15. We've come down. And we actually already got near the lower end, but we've rebounded today into the medium. Look at the score, 2%. So with that movement, the AI thinks there's a likelihood we're going to break one of these boundaries. I don't know about the option side of this, where there's enough liquidity to even think about anything. But the setup looks intriguing, especially with the score that low, that something could happen here. It's oversold from the 10-day moving average. I'll do some options analysis on that as well once we complete this show. But those are the two that would be interesting on the sideways search. So with that, Zach, that's pretty much on the AI side what I wanted to go through and run through with the folks, and we'll see. I did want to show, because the question was asked either yesterday or Monday. I can't remember which day it was on CRK. which was one that performed pretty well. As you can see, almost exactly touching this after a little bit of a pullback. It must have been on Monday because it was this pullback day where the question was asked. So that must have been on the EWO live show. And I looked at this one because it did have a 75% score, but I didn't like the liquidity on the out of the money options here. And I didn't really want to do a spread because it was a low dollar stock. And when you have a low dollar stock, it doesn't tend to move as much, and it makes the spreads less attractive if the stock itself isn't more volatile, forgetting the volatility in the market itself. So I just wasn't comfortable with where the options are, but apparently some of you did do that, and hopefully you exited on the high yesterday as it got awfully close to touching that upper level, as I mentioned. So I wanted to come back to that since clearly some of you, I would assume, because the question was asked about it, did get involved in that one. So I hope that worked out well for you. And I just wanted to give you the reasons why we didn't send out an alert on that when it had a score of 75 or above. There was liquidity in the options, just not enough liquidity. This was kind of the old school days. Back when it first started talking about that 25 to 30 delta and where the delta gamma acceleration is, all that, all the things that put me on the map in the world of options trading, where we would have really low open interest down there. But I was just such a believer in it, would do it anyway. And now it seems like the market has caught on and there's a whole lot more liquidity in the out of the money options than there used to be. But there wasn't here. And so, that kind of leading the pack part has waned a bit. A lot of other people now realize it. And that's a good thing and a bad thing. The good thing is by having more liquidity there, it's easier to get in and out of those trades down around the 25 or 30 delta. So it's not necessarily a negative that other people are figuring it out. Could very well be viewed as a positive because of the extra liquidity. The negative side is what we saw with this is that, oh, okay, people have figured out the benefit of trading those out of the money options and looking at those deltas. Why weren't more people doing it on this? So that brings just a little bit of a doubt in there now that there's more liquidity in the out of the money options. So that was the reasoning. Could say that we missed this one, but some of you, I think, got it. And as I said, hopefully you exited yesterday because on the high of the day yesterday, we were getting some separation from the 10-day moving average, and this consolidation today certainly warranted. Now it may turn around and go back up and hit that level, just like we did on Uber, but we'll have to wait and see. All right, Zach, if there's any questions in the world of AI, happy to take those. Otherwise, we'll get back to our trading day.
Thanks, Rob. I see we are a minute after time, but I got one quick question for you from Alexandru on BX, please.
B as in boy, X.
Yes, sir.
Okay. Good old Blackstone, pretty well respected company there, and followed through with the gap, meaning that it had the same gap that everything else did on Monday. Obviously not a follow through day, so I want to be clear on that. The likelihood is that we're going to go back to the previous four. We got awfully close to it, which would be that 100% level there. But normally those lines get touched on the fib levels. So I would think that there's probably still a little bit more upside to go here. You could argue that the consolidation here is nice following the gap up on Monday. We do have the bullish 1030 cross. And so going sideways perhaps means that we could break above that 100 level. And if we did, then you're going to have a pretty good run up to the next resistance level, which would be right in this area, about 165. So you can see we're trading just under 150. And that's what I mean. You could have a nice run there. So if we can break above this level here, the 100%, retracement right back to the previous 4. You still have room to put on a trade. So for me right now, it would be a good watch list trade. Let's see if it can break above this 155 level. And if it does, you got almost a very quick 10 points, I would think, because there's no resistance to stop it from getting up there. So I would certainly keep that one on the watch list for a continued move higher. Even it only turns out to be 7 or 8 points instead of 15 points. It looks to have a little bit more upside, but the more conservative trade, if you're very aggressive and you're already in it, there's no reason to get out. If you're looking to get into it and you're aggressive minded, then you could go ahead and do something now. You would have risk all the way back down here, though, to the 135 level. So that would be your risk amount. But if you're super aggressive, speculative type money, and wanted to jump in on a break of the previous 4 and a move to the next resistance level, you could do that now. But if you're more conservative, let it break that 150 level with a little follow through. And then I think you still have plenty of time to take advantage of that move. All right, so hopefully you found that informative. I'm going to get back to work and look at those 2 that we identified as potential candidates for today, starting off with NTR there on the Wave 3 bullish search. And I like the fact, again, that we're getting a little bit of a pullback today. So let's get back to work, and you may very well see that alert come out within the next hour or so. We'll see. And if you don't see them, it's because I didn't like the way the options looked. But the chart looks really good as we went through the DMI and CCI for confirmation. Might as well give you one more quick look at another confirming indicator. That's the CMF. And you can see that looks pretty constructive as well. Money is flowing into this stock. So pretty good confirmation across the board on our confirming indicators. So I like this one a lot. Again, doesn't guarantee anything. Nothing's ever guaranteed. Nothing ever gets to 100%, but you like to have as many percentages in your favor as you can. So let's see how that plays out. Have a great rest of your afternoon, and look forward to talking to you tomorrow night during Trade Finder. Take care, excuse me, insiders. Take care, everybody.